Hey everybody, so today I'm going to be making this video to talk about Chinese companies and Chinese stocks and why I think that 2026 is actually a very bullish year. I think that so far, if you follow the Hang Seng or if you follow the Chinese or Asia markets or just global markets in general, you'll sort of see that there's a lot of signs that we sort of bottom perhaps. Not for sure, but none of this is financial advice. Please do your own research. Anything I've ever said, anything I will continue to say, is a joke at best. I'm not. I'm stupid. I'm not a professional of any sort. I'm a fool. Okay, so none of this is to be used as financial advice in any way. I am not an expert in this. I am just I am just a fool with their opinion. Okay, so this is all just a joke. Okay, so with that being said, yeah, I want to say this. When you look at the United States, there's numerous reasons as to why I think that as rates lower, as global liquidity expands, as invest as firms look for and investors look for higher return on investments and higher and better risk reward, you know, I think more you're gonna have capital move more into China, and I have numerous reasons as to why I think that and why I think it could benefit Chinese companies, especially companies like NIO, Alibaba, and just numerous from their balance sheets to the actual company itself. Okay, so I'm going to be talking about that, and I have a lot of tabs open, unfortunately, so we'll see why I opened it, and maybe I'll just talk about things from a quick point of view. Okay, so yeah, when you look at PE ratios by countries, if you're an investor, you want to find your highest return on investment and your lowest risk for the highest reward. Currently, China is that. We've seen a lot of positive sentiment socially and economically from China, and we've seen a lot of negative things geopolitically, socially, and economically coming from the United States. The true rate of unemployment is around 24.8%, based on Ludwig Institute's website. But headline unemployment as of November 2025 is around 4.6. So yeah, that's not good. That means that the real unemployment rate is not doing too well. And how unemployment rates are calculated can be very misleading. So yeah, the unemployment rate in China is around 5.1%, while the unemployment rate in the United States is 4.1%. And having stable prices and higher rates of employment supposedly builds stability, right? Economic and social stability. So that's the country's goal. When we look at NIO's total number of employees, as of 2022, it's 26 point, but I'll look on Simply Wall Street later to get a better idea of NIO. But yeah, basically, a lot of these countries and companies like NIO, while they do have their goals as a company to become profitable, they also have national interest, right? Like to boost unemployment, to boost global productivity, to help their countries' initiatives and goal. And then these companies are often incentivized to do so, and so they'll get government subsidies or government assistance. Xpeng, for another example, their employee count has been increasing over time as a whole, but more so NIO. And the reason why NIO is a very important company is because it provides many jobs. When I was investing in NIO, I think around 2018 or 2019, one of the biggest things I knew was that the infrastructure that NIO was developing, from their NIO houses, their battery swap stations, and the manufacturing capabilities and production, would lead towards higher employment, which is something that the country wants as a whole. Yeah, it's going to provide a whole network of different types of jobs, such as like manufacturing, research and development, and service based, right, from your NIO houses and your battery swap stations. So NIO is a company that you don't want to fail, because if it does, then your country's going to lose thousands of jobs, which is not good. And the infrastructure, it's efficiently ran by this company NIO. So because of the supply chains, because of the network developed, like, the country would take a huge hit economically and socially if companies like NIO were to fail, right? So they often get bailouts or they get support. And so when I took the bet in 2018 or 2019, I realized that, look, you can't let this company fail. It would just cause too much harm towards the economy. So that played out well. With companies like XPeng, it's a little bit less apparent, mainly because like I don't believe the infrastructure is built out, but they still do provide a lot of jobs and a lot of infrastructure. And when I look at Chinese companies in general, like NIO or XPeng, it seems like a lot of these companies were made to be were made to move over to the United States and Western countries to build manufacturing plants or to start selling their vehicles, because in a domestic market it's very competitive. So with that being said, let's see. Yeah, we have some more recent data from 2024 where, yeah, employee count was 45,000 as of 2024. So if a company like NIO were to fail, all around China, 45,000 people would lose their jobs, along with the government having to seize the assets, or other companies will have to take control of the assets. So yeah, it's not good if you let companies like NIO fail. Fisker, for example, which failed, doesn't cause as much systemic harm because it's such a smaller company with less connection and ties to the infrastructure. And so what NIO is doing is that as the company keeps growing, its revenue and scale and its size, physical size as well, it means that the country and the government is more incentivized to ensure that this company does well. Because if XPeng fails, yes, that's a big deal. 15,000 plus people lose their job. A lot of the vehicles will have to be maintenance through some sort of means. But at the same time, none of that's free. So someone's going to have to take on those burdens, whether it's the government or whether it's the province or whether it's a different company. Yeah, someone's going to take on those burdens. But with NIO, for example, the cost and the burden would be so high that, yeah, it's in every government's incentive to have this company do well. So China's unemployment rate as of in 2025 was averaging around 5.1%. This is November 2025. So these numbers can change, right? I'm not too certain as to why the data was here. It could have been, unfortunately, I don't have like a 25-30 year time horizon of unemployment rate, but you want unemployment rate to go down. And a lot of this could be because of things like tariffs, right, which slow down production. If tariffs are reduced, which I think will happen soon, I think that you will see like unemployment drop drastically, both in the United States and China, along with a lot of the deflation being exported from China to the United States, which is something I think happened in 2008-ish that really helped the United States economy when they were going through a very hard time. So lowering tariffs and being on better terms with China is in everyone's interest for the most part. Well, when you look here, yeah, unemployment rate has rise, so you want these numbers to go down in China. Let's see, to 3.97. So yeah. Okay. There's another thing, other unemployment. Oh, okay. So looking here, one of the main reasons why unemployment rate could have averaged around 2 to 3% in the early 1990s, 1995, is because China, in a lot of ways, is just like Japan post World War II. So Japan used a lot of like SOEs, special operating economic zones. I don't know. I'd have to look at the right term, but basically, like a lot of it, there was a lot of government intervention, and there was a lot of inefficiencies as well. But you need to establish these businesses and industries, and you need to urbanize more. So they used SOEs, and so I think as the markets and the economy allowed for more privatization and less government control, then I guess liberalized. I don't really know these types of terms, unfortunately, but yeah, as more like private enterprises were allowed to form and became more dominant, then markets, labor force became more efficient, and urbanization increased, but unemployment rise because there was less inefficiencies, right? Because you had a lot of SOP and government owned businesses, enterprises. Similar, so like a lot of the things we see of China now is the same stuff we saw in Japan when they were doing really well. And a lot of the disputes comes from the fact that there are 1.4 billion plus people in China and Asia, and they're moving up from second to first, and you need to somehow reorganize the global economy and society to fit in that amount of people in a world where there's like 8 point something billion people. So Trump to me is very much globalist. Lower rates, tariffs to encourage lower rates as well. Wanting foreign direct investments. Yeah, basically there's a lot of reasons why I think that Trump is more of a globalist than people really consider, or at least the news does. So United States manufacturing payrolls have been going down for the past 5 years. We see here. So if you want to boost these, you really want to reduce tariffs. You really want to bring foreign direct investment from your greatest competitor. One of the biggest misconceptions is that like China is an enemy. I don't think that anyone really feels that way in the United States, unless you're some kind of business that directly competes. But I don't even think that companies like Ford really believe that. They would definitely prefer to have joint ventures, because here's two things that can happen. One, you can either not form joint ventures and partnerships with Chinese firms and Chinese businesses and Chinese vehicle manufacturers, and you're going to lose in the global markets, right? So, and then that's why you have tariffs. Or you can form joint ventures and partnerships and try to integrate more and create supply chains so everyone can grow globally. And so global liquidity will increase. It'll encourage lower global interest rates as well. It'll increase global production, which will allow for the global society to increase in productivity, which make borrowing costs lower if the United States dollar drops. And it allows for other currencies to strengthen versus the dollar and other Western currencies that have done well, which makes paying off debts much easier. It allows for capital to flow into these countries as well. So yeah, you do want Chinese electric vehicle companies to come to the United States. It'll really help manufacturing, just like we saw when Honda and Toyota came to the United States in like the 70s, 80s, and 90s, along with other like South Korean companies as well, because you want to boost manufacturing costs, right? So you can have the yuan strengthen, but you can't have a scenario where the yuan strengthens tremendously and makes their exports very uncompetitive. You need to have it so it doesn't even make sense for the yuan to strengthen to that point as well. Like you would expect them to become like second America, which is it's not. I don't think that's a good idea. So you want the yuan to strengthen because it's good, and you want the United States dollar to lower in value as well. So I'll be going more into that later. So yeah, let's see. So since September 2023, interest rates have sort of stabilized here, and they've been dropping ever since then. I think it was very similar, right, to, let's see, I think there was a lot of things that are very similar. Let's see, July, September. Well, yeah, I think there's a lot of things very similar to 2007, 2008, like when interest rates were in '08 were around 5.28 and they started declining. I think it was very similar where we had interest rates decline around the same amount at the same prices as well. So we can see a lot of the same needs for the same types of resolutions and remedies. But yeah, so interest rates dropping is a good thing for Chinese equities and Chinese stocks, and It's also good if you want to promote capital outflows from the United States and into the emerging economies and into China. I was trying to look for more sentiment, but let's see. I found one here. Okay, so in a letter sent to Trump's translation team yesterday, a powerful automaker lobbying group claims automakers cannot compete with zero emission cars. Okay. I'm not going to read that. So I also want to read this too. NIO expanding into Singapore, Uzbekistan, Costa Rica between 2025. Yeah, I think this is generally a good thing. I thought they were moving into Australia, but I could be wrong. But yeah, some of these are very Western markets, so that's good. But I don't think that really mattered to what I'm trying to. The EU trade deal, it's okay. I won't talk about it. Okay, so yeah, when you look at Canada, right? I think that we see a lot of positive like sentiment between Canada and China, and it's mainly because you can view United States as an aggressor, which they are, but at the same time you can view that both Canada and the United States do want Chinese foreign direct investments, right? And it would benefit Canada greatly if Chinese foreign direct investments and Chinese electric vehicle firms were to move towards building partnerships and joint ventures in Ontario. So I think I haven't read too much into this, but yeah, basically like a bunch of Western countries want to partner with China more is what I'm seeing here. And if you look at Canada's unemployment rate, it's really high. So if you saw it that the United States unemployment rate was high, I mean, Canada's real unemployment rate must be much higher. I mean, I've heard about the asset bubbles there, and their PE ratios are slightly lower, but yeah, the unemployment rate in Canada must be very high. So Canada's economy relies heavily on exporting things like, let's see, vehicles, petroleum, natural gases, minerals, and ores, lumber, which the tariffs in the United States are negatively impacting. So if you want to partner with China and build factories together, then it can really boost up the regions there. So moving on to things that I find a little bit more important. Oops, not this one. There we go. Ooh, what am I looking at here? Why do I have all this? Okay, that's fine. So yeah, right here is the Great Lakes, and you have Ontario, Canada over here. So what a lot of countries want, what really needs to happen in the United States is that there's been a shift going on for a very long time where if you look at the unemployment rate in the United States, there are certain states with high unemployment rate, and there's been a mass exodus of like businesses from blue states going into red states where it's like a little bit tax friendlier, a little bit more business friendly as well. Other countries or other states like Hawaii, for example, or maybe Canada, California use a lot of service-based industries and service-based jobs. So you want to revitalize the Rust Belt, and you can do that by bringing back manufacturing companies, manufacturing by forming more partnerships between Chinese companies and American companies, which will be much more competitive globally than a Japanese or South Korean company coming over, or a European company. And so Ontario is here. So basically you have the Great Lakes here, and you have canals everywhere which go all around, all throughout the United States. So you can revitalize a lot of the employment here in the United States by having manufacturing and production go up, more partnerships forming as well. And you can revitalize things like canals, towns, cities, jobs, for like these restaurants, infrastructure, along with production and manufacturing, which will lower, and when you do that and you lower interest rates, and you lower, which is what all the countries seem to be doing, a lot of the Western countries seem to be doing, you can promote countrywide growth and job production. So I don't know what I have here. Yeah, so the United States federal interest rates have been dropping, which is a good sign. A lot of other countries like Canada and the European Union have been dropping their interest rates as well, which makes borrowing costs much more affordable. I don't need this. The Hang Seng has been doing pretty well. I guess there's higher. Yeah, so yeah, the Hang Seng has been doing very well in the past year, and that's reflected in stocks. So maybe that can be an indicator that people smarter than us are seeing that there's just a lot of value here, or that there are conditions that are changing that make Chinese assets more attractive. The S&P 500 has been doing pretty well too, but at the same time you can see that it's having a little bit of a trouble here, but we'll see how things play out over time. More importantly though, when you look at things like the United States dollar, the value of the strength of versus the dollar, the Chinese yuan has been growing, which could make for things not like the yen carry trade, but it can attract capital flows into the yuan and Chinese denominated assets. The 10-year treasury yield has been going down too, and it's not it could be in response to lower federal interest rates, and just along with like economic and global conditions making maybe US treasuries or US assets not as attractive. So over time, if yields keep dropping, that could be a great sign. I mean, it could be good for the United States because it makes financing their debts much more easier to do. But you can balance between private and government and private and public sectors to like sort of manage your debts or how you want to grow your economy. But yeah, overall, looking at the interest rates here, the 10-year yield that is dropping, I mean, maybe we could see this drop even more over time, while the 10-year Chinese government bond increases over time. So I don't know. Yeah, so if we look here, in the past year alone, since last year, January, yield interest rates on the yield on the 10-year Chinese government bond has been doing pretty well. It's been growing, and when you have yields on the United States treasuries go down, along with stocks, equities, and assets being really, really expensive, like that's why we look at CAPE ratios or PE ratios, and we're looking at the AI bubble, then the risk versus reward seems much lower, right? So you know, how much more can Nvidia double? How much more can Palantir double? How much more can the S&P or housing market or other assets value? I mean, there's actually a lot of great deals, in my opinion, in the United States market if you look in smaller cap or med caps. But when you look at the systemic risk of like the AI bubble deflating, or like some asset bubble failing, or some kind of bank not doing well, if the Fed is going to be forced to lower rates, then can we see a situation or scenario when something crashes, right? I mean, that's what I would wonder if investors are considering. So to me, I mean, if yields on Chinese treasuries are going up while yields on United States treasuries are flat or they're possibly going down, then we may see more capital inflows in towards China and create like some kind of positive loop where more money moves into Chinese investments and assets, which makes them more attractive, and then like a snowball effect of momentum. So I mean, it's very possible that, yeah, a lot of smart people have been seeing this already. So we already see that the Shanghai Um, Shanghai Stock Exchange Composite Index kind of shows that, yeah, in the past 5 years it's gone up by 15%, but in the past year alone it's gone up by 30%. So from its all-time lows, recent lows, like, yeah, it's almost doubled. So, smart people could be already seeing this since then. And global liquidity has sort of slowed down, so you generally want these things to go up as well. This is the Chinese. I thought it was interesting looking at this. I mean, the total M2 money supply, or the total money supply for the M2 in China has gone up tremendously since COVID. It's nearly doubled since March 16th, March 2016. So let's see. But anyway, so more importantly, I'm looking at here at the global interest rates. I don't really know how accurate this is. I don't think it's very 2025. Okay, so it's not. This may not be accurate towards like today because it's as of May. Because I know the United States interest rates is much lower than 4.38, but as you can see here, global interest rates has a lot to come down. So yeah, this can make money borrowing. 1 second, sorry about that, I had to use the bathroom. But anyway, so as Western countries continue to lower interest rates and devalue their currency, then perhaps we could see that, yeah, more capital flows will move into China. The yuan can strengthen over time, especially if they're going to try to consume more commodities so they can boost global production. So if we see global liquidity rising, if we see global interest rates lowering on average, if we see that global demand is allowed to increase and global productivity increases as well, and there's more liquidity, so more borrowing, more production, and we see that commodities could go up prices if tariffs are reduced as well, and we see more investments into the Western countries from China and Japan and all these other countries, then perhaps we could see a yuan strengthen while other Western currencies and other Western assets kind of devalue. So we'll see like a capital outflows from the West into the East. And if we see something like that happening, and we have things like stronger yuan, then there's a lot of room for profiteering here. 10-year Treasury, United States inflation rate. I mean, you don't have to. There's a real inflation rate, and then there's like a inflation rate that economists in the United States use, right? Like, you wouldn't, if you consider like inflation rate based on your own criteria, you may not agree with these metrics, and that's fine. I understand that, because everyone would agree that inflation has gone up and the value of the dollar and our purchasing power has gone down as well. But it's all relative, right? So if economists in the United States and the Federal Reserve may agree with you on how you view inflation, how you feel your wallet, and how your dollar is doing, could be going up or down, economists will generally focus on this when making rate decisions along with other things as well. So if as of 2025 in November we're at 2.7, it could leave some room for rates to be cut as well. Let's see, inflation rate, don't need this. So with that being said, I wanted to focus more on NIO now as a company, and Chinese companies in general. Most companies like NIO, Chinese companies that are traded in ADR, while they're listed on like US markets where they can raise capital by Western in dollars, a lot of their assets are valued in RMB. So things like their short-term bonds or their cash on hand or any kind of liquid asset that they have is generally going to be denominated in the RMB. So if the yuan strengthens versus the dollar, for example, like by 10%, then investors from the United States may gain 10%. It's not cut and dry like that, but yeah. So basically, China, if NIO, for example, has I don't know, let's just say they have $5.1 billion, but most of that is in RMB. If the RMB strengthens by 5 to 10%, then its cash position strengthens by like around 5 to 10%. Now, it's not straightforward like that, but if you're an investor, you might think that you can gain from a stronger yuan if you invested in a little bit earlier, along with you gain some kind of added bonus as the yuan strengthens, and and the company's financial position benefits as well from having stronger assets. If you also think that commodities will it could grow, commodity surpluses can grow if there's more global production. So you might think some commodities will go down, some commodities will go up. It really depends on where you're sourcing it from and how the deals are made, and it's very unique. But if input costs generally stay stable, or they rise or they lower because of the global production, if you're looking at 5 to 10 years out and you think that commodity prices will overall be stable or drop slightly while the yuan strengthens, then what percent gain are you seeing relative to today if you're buying a Chinese company that is priced in RMB and trading in RMB and buying commodities in RMB? So if Chinese government bonds go up in yield and the yuan strengthens versus other currencies, including developing emerging markets, then companies like NIO can buy commodities input costs at a cheaper cost, while their cash position strengthens as well against other currencies, making the investment even more attractive. I'm sure investors thought about something like that, which is why we saw the company stock do well. But yeah, that's one way. So it's not exactly like the yen carry trade, but you can benefit in similar ways by like FX differences, right? So when you look at things like the China risk, currently, to me, I mean, we're already seeing signs of de-risking, and it's mainly because when you see sentiment from socially sentiment, like China is being more viewed in a positive manner in social media, and you see that the United States is actually just much worse, whether it's from political instability, domestic and economic issues, and things like that, which I don't think I'm allowed to say, but if you really thought about it, you could probably identify numerous ones, if you really think about it. Then you might look at China as economically and more socially stable, with a safer investment, with lower CAPE ratios that make their company seem much more attractive and their assets much more attractive, along with the economic stability. You can see that things like their yields on their assets and their return on investment opportunities are much higher, especially if we see yields becoming more attractive along with assets becoming more attractive in general. So here I wanted to talk more about the whole thing with silver and the COMEX. Now, I do own silver myself, but I don't really want to talk about that. I think my average is anywhere from like 15 to 30. I've had it for over a decade, so not very happy with its performance overall compared to a lot of United States paper stocks, but that's fine. But what this does reveal is that there's a lot of there's a lot of opportunities for like systemic issues to occur within the United States, but overall this can increase global liquidity and the Fed to make borrowing much easier. So this can be done. Let's see, what do we have here? So I understand that there's been a lot of news about silver recently, and I kind of follow it here and there myself. But one of the biggest speculations I've seen, and I've seen this speculation for years, and I think maybe there is some truth to it, but the context is that several major banks, including J.P. Morgan Chase, are rumored to have massive short positions. And with silver rising and the demand for silver rising as global productivity grows, more Demand for silver rises as well. For whatever reasons, whether you're betting against the dollar or if you think global inflation is going to rise, whatever it can be, or just manufacturing production wanting silver more, there isn't enough physical silver, and most of the supply chains and manufacturing production and minings are owned by China. So, one of the things that I've heard is that, if the Fed or the government doesn't step in, if margins aren't increased, there could be things like cash settlements, for example, but there could be a situation where the Federal Reserve might have to bail out one of the banks or firms or some kind of hedge fund that is shorting silver, and they're not able to meet their margin calls, or if they are not actually able to provide the silver that is demanded due to the short position. But yeah, so I mean, to me, when I looked at it and I heard the news about the Fed, I think they had some kind of stealth QE or some kind of stealth bailout. I mean, whether you agree with it or not, I mean, basically, you can look at it like silver prices rising in response to the people wanting precious metals to hedge against inflation, or people thinking that there's going to be more inflation moving forward, or the demand for silver rising, or supply chains being restricted because of government policies from China, for example. And all these things can be used to encourage the Fed to lower rates. So if you think Trump is a globalist, if you think that Trump is actually on China's side because they want to bring foreign direct investments and Chinese electric vehicles into the United States while lowering interest rates, then perhaps this could all be a way to lower interest rates fast as possible. Because when you have high borrowing costs, it really does negatively impact other countries, like emerging markets where there are people who rely on US dollar denominated debt, global production increasing. Third world countries, second world countries, they do benefit from a stronger yuan and a weakening dollar, because they want to get more value for what their production is. They want to borrow at lower cost. They want to pay back their US denominated debts at a lower cost, and they want more capital to flow into their countries as well. So when the US dollar strengthens versus other currencies, it acts sort of like a vacuum, sucking away resources away from other countries. So this could all be a way to incentivize the United States to lower interest rates faster rather than push things along. I mean, it's been relatively slow. So yeah, the yuan strengthening versus the dollar can be a really good thing for Chinese companies' balance sheets. So when you look at things like delinquency rates for like commercial banks, what we see here is that, yeah, I mean, it's never going to be the same as this, I would imagine, mainly because the Fed has more tools now. Ever since then, they've introduced things like QE and quantitative easing, for example. So they might not rely on the same tools. So you may not see this many delinquency rates this high. But when you look at the past 5 years, since Q3 2022, delinquency rates have gone up tremendously. I mean, this may not look much to you, but every 0.1% matters in the real economy, especially with tools like quantitative easing and more Federal Reserve when you have more Federal Reserve interventions and government interventions and tools, then these numbers and these jumps mean much more, especially when you have a massive decline. So I know we had a lot of issues with some banks closing down, like in La Jolla, San Diego, something I used to see all the time. I forgot what it's called. I don't want to start. It starts with an S. But yeah, banks are consolidating. Banks are closing down. Delinquency rates are also increasing as well. So yeah, I mean, you might look at this chart and think, well, it's not high like this. But again, the Fed tools are much different now. So the fact that it even got this high in general, and how after quantitative easing and Fed tools since '08, have lowered it down, then yeah, these are systemic things, like systemic issues. So I don't really know how to articulate it, but I would imagine that it's much worse than this 1.19 to 1.59. Like this 40%, this 0.40 difference is probably much more severe than can be seen here. And then when you look at things like delinquency rate on consumer loans, the only time we really saw these things drop down was when we had easy money, lower rates, but they've already surpassed our Q1 2020 highs. You know, I remember during this time, I actually have proof that I was betting against the US markets and that I was bearish on the markets, and I predicted accurately when I thought the market crash would happen here. I have proof if anybody's interested, but it doesn't really matter. Honestly, it doesn't matter. Yeah, I felt at this point the economy is running really hot. And, you know, at this point, we're already past that. So, with all the tools given, what does this mean? Like, how do we articulate this, right? Now, I don't want to make a video about that, but right now. But yeah, as Fed rates drop, money becomes easier, borrowing costs become lower as well. So the dollar has been weakening against many currencies now overall. Dollar versus yen. But anyway, so yeah, I think we can see numerous positive things, catalysts for NIO. One would be like, strengthening balance sheets just because the yuan is strengthening over the US dollar over time, perhaps, maybe. Chinese assets, Chinese stocks becoming more attractive in terms of risk versus reward, and just becoming more attractive in asset government yields, for example. So we might see more capital outflows from the United States into China, and we might see how these capital flows change in nature. So it's not like capital flows moving from the United States to China is good or bad for the United States. It really depends, like, how you balance things. Like, maybe it can help the real economy more while propping up the financial markets at the same time in the United States to act like a UBI, but letting certain assets and stocks perform a little bit less better to control the economy, to control the labor force, to act as UBI, but promote more resources, and by reducing tariffs, reducing inflation, and growing production into the real economy. And at the same time, you can allow for China to financialize more, allow for more capital inflows, and allow for global production to go up. I mean, you're going to want a stronger yuan when you start buying tons of commodities if global production is going up. So this can help companies' balance sheets that are denominated in RMB, like NIO, for example. So another thing I see happening, if we really want to see a company like NIO do well over the long term, at least when its stock price, because I think the company is becoming profitable, is realizing this. I think a lot of firms and institutions realize that a lot of Chinese companies have been, despite a lot of international demand dropping and a lot of tariffs and things like that, lowering their profit margins, and the electric vehicle price war hurting profit margins as well. Despite that, you're having a time where there was, like, I think it was like 300 to 500 electric vehicle companies, and I think now there's like 13 to 20-ish, if not a little bit more, that have either consolidated or gone bankrupt. So generally, if you're a governor, or if you're a politician or a business owner in the Rust Belt or in Ontario, Canada, like, you want these Chinese electric vehicle companies to bring their capital here, research and development, labor and supply chain, things like that, and their financials and their finances as well. You want them to bring it here, but it's a two-way street, right? It's a two-way street. So how this can be done is that you can have the United States and Western countries lower interest rates to make borrowing costs much more affordable. So a company like NIO can have its stock price appreciate in value and raise capital primarily off of Western firms and Western capital, and they can use that 2 billion or 3 billion to build factories in the United States or in Canada or in Europe. And this de-risks for companies like NIO who maybe don't want to take on the risk initially and use their own capital and their own resources, because when you raise capital off Western markets and you build factories in the West using that capital, and interest rates are low and borrowing costs are low and labor is increased, if you want to like crash Bitcoin, for example, or other meme stocks or whatever, AI, whatever, like, you can increase the labor supply, so you have cheaper labor costs. You can structurally change agriculture. You can revitalize the economy, shipping lanes, towns, things like that. So you can borrow at lower costs, and you can raise capital off Western markets, which this, in a sense, de-risks a lot of the costs, upfront costs for NIO and Chinese companies. And then you can build these factories using Western dominated supply chains, Western resources, Western laborers, Western capital. And so it de-risks the companies, but it allows for these companies to have access into Western markets. And then you can have some kind of balancing act between the manufacturing plant in America and China. And then, in that sense, you have a exchange where the stock price appreciates, the shareholders gain a lot, and at the same time, you have companies and businesses here, and you just have global economic growth because there's more demand for the vehicles now, rather than excess capacity. So, that's one way it's kind of mutually beneficial, because it's good to have deflation in your country, and it's been very beneficial, but you also want to have global productivity at the same time. I mean, it's very possible that China could do fine without the United States, but we have institutions like the United Nations, the World Economic Forums, where you want everyone to win for the most part, right? So, yeah, that's one way you can do it, and then you'll see the stock appreciate in value from that. There was another one, with the strengthening yuan. That's another way. The balance sheet can be seen as much more attractive as well. I don't know if I had a few other things in mind as well, but yeah, at that point you might see the China discount totally be removed, because there's mutual benefits from the stock price appreciating and the company doing well. But yeah, I mean, with increased global liquidity, it benefits mostly everyone. Weaker US dollar, stronger RMB, more easing level liquidity, easier borrowing, global risk on, supposedly, and consumer confidence in China growing as well. And if you have the wealth effect more in China, then they can also increase the global demand as well for goods and services. So if the United States, thinking about it like this really made me rethink a lot of how I view the global economy. And this is because even if we see that there's tariffs, I mean, the tariffs were tools for negotiations, but they can also be used as tools to change supply chains, increase spreading out of resources, changing how global economic flows are made as well. And it might have needed to have been done if you really want to push internal combustion engine manufacturers to transition or prepare themselves for upcoming Chinese electric vehicle joint venture or competition. I don't think the intention was ever to make American automakers compete with China. I don't think that was the goal at all, but I think it was more of an infrastructure change to allow for 1.4 billion people plus from China and South and Asia to be integrated into the Western and global markets in the first world country. I think that's what it was mainly about. And you do need to revitalize the economy, canals, supply chains, and you need to make them more efficient, along with maybe offshoring things or nearshoring certain things, depending on like where we want the world to head. So when I it made me really reconsider like how I view political news and economic news as well. So I think that overall we're going to see way more capital flows into China, and I think that we're going to see the stock prices probably reflect that as well over time. And yeah, I don't think I have much else to say. I mean, I'm probably going to make a more specific video later, but this is just like an overall view. I have much more to say, but it's fine because I could probably talk about this for like days, which I don't want to do. But yeah, we really want to see the United States lower interest rates. At the same time, we don't want them to have an economic crash, right? We want them to lower interest rates, make borrowing costs much easier, open up global liquidity, lower the value of the dollar, and we could see an opportunity where it's like all these things come together that benefit China and their companies' balance sheets tremendously. And I think overall with the Chinese electric vehicle war, price war, pretty much, I think almost like pretty much done. I think it's pretty much done, honestly. Like most of the junk companies have been beaten out. I think we're going to see a lot of Western countries wanting to do partnerships with the winners. And I think that a lot of countries could benefit heavily from an infrastructure intensive company like NIO, which builds up not only electric vehicles, but the grid as well. So we'll see how that goes. Maybe I'll make a video more specific to the actual company. But yeah, with that being said, I hope you have a great day. Thank you. None of this is financial advice. Please do your own research. Thank you.